Hello and welcome to this week's episode of The Capitalist Investor. As always, you have me, Diamond Hands D, and this week, Tony the Tiger. What's going on?
Yeah, Luke's on assignment.
Yeah.
So you got two of the three dream team here.
Yeah, absolutely.
All right, man. So let's kick off today's podcast with the financial planning corner, and what we're going to talk about today is emotional investing, behavioral finance, being bad, being bad.
Oh yeah. Lots of people do it.
It's alarming, actually. I do it myself in my personal account. Sometimes, like, oh man, I'm gonna sit this one out, or I'm gonna jump on that stock, and then it craters. But here, what we're really here to do is talk about, I guess, checks and balances when it comes to your investing. So I'll start off by here saying is that there are industry studies that over the last 20 years, I believe from JP Morgan, that the average investor underperformed the stock market by 3 to 4% per year on an annualized basis. Mm-hmm. I also saw another study where, and it's not even a study, it's more of just backing up the thesis, and you've probably heard us say it before, where time in the market is greater than timing the market. Trying to figure out what the next move is can be detrimental. I've seen people do that last August, November, because again, at the end of the day, I'm not here to, the way I describe it is I don't run a dictatorship. I don't tell my clients what to do with their money. Mm-hmm. I give them advice and say, these are multiple paths. This is the path I like, and this is the one that makes the most sense. Are you cool with that? And if you are, then we're going to go down that avenue. Mm-hmm. But when clients are like, I don't like any of those paths, I'd actually like to go to cash, Tony. Yep. And then we have a discussion and things like that. And if you've done that in the past, since COVID, you probably lost, you missed out on money. Yep. You probably still have made money, but you missed out on money, because there is a statistic that I saw from one of our research firms that since 1995, so that's about the last 30 years, if the market has done, I'll just call it approximately 9% in that time frame on an annualized basis, like maybe 8.5%, 9%. If you missed the 5 best days in the market in 30 years, okay? We're talking just 5 days in 30 years. Mm-hmm. You missed out on approximately 2% of annualized rates of return. The ironic thing about that is those 5 days of the best market days probably came within 1 to 3 business days of the worst day. Yep. And when the market's cratering, you hit the panic button and you sell, and you miss the bounce back the next day or whatnot. Yep. That's a problem.
Yeah, that's the thing with timing the market, right? People don't realize it when, even if you make a great move and the market's heading down and you pull your money out of the market and it continues to head down and you feel great that you've made an awesome move. But then you also have to time it when to get back in the market. Right. On the upside.
You got to get it right twice.
Yep. You have to get it right twice every single time.
Good luck.
And that's really the difference in all those stats that Tony just threw out. Is not that people are picking, bad stocks or, stock A versus stock B. It's almost always all attributed to that behavioral finance.
You're not involved.
Exactly. Exactly.
It's not like you perfect way. It's not because you picked maybe the right stock or the wrong stock. It's because you are just not involved.
Yep. Absolutely.
And the problem with that is it's an irreversible financial mistake. You cannot undo it. Yep. And then you get back in the batter's box like, oh my God, how do I make this up? Mm-hmm. And then you start getting aggressive. Maybe you want to buy options. Absolutely. You want to start, okay, what's the next thing to get me 100% rate of return that could easily give you a minus 25 the next day? Yep. Exactly. It's it's a thing, man. And it's not good. So the moral of this story, and we say it over and over in the financial planning corner, is by having a financial plan. It always starts with the plan because it gives us the blueprint. It gives you the crystal ball to look in the future. What it does is that it's going to help us design the least amount of risk that you can take or should take with your still having a successful retirement.
Yep.
That's what it's about. Like, I want to bring on the least amount of risk. I want you to sleep well at night. But I also know I just had a couple conversations in the last few weeks with some of my older clients. I'll say maybe over 65, 75, like older clients in that realm, and they still invest. And I joke with them with this. I'm like, man, you still invest like you're 35 or 40 years old. They're like, yeah, I know it's worked out, but I know it can't do this all the time, but man, it sure feels great, And I'm like, I can't fault you because you did the right thing. You were aggressive at the right times, but you don't need that much risk. Or it's a conversation I'm like, you've already won. Like why do you want to continue down that path? And that's a personal decision. Like I said, I'm not going to tell you what to do.
Yep.
So.
Yep. And the important part of investing when it comes to financial planning is to make sure that you have an accurate, rate of return inside of the plan and an accurate standard deviation.
Yeah. If you have a financial plan done, what we do for our clients, and that's a great point, Derek, is that we are trying to do future projected returns, because if some advisors will build a plan with historic rates of return.
Oh yeah.
And if we got a historic rate of return of 10% over the last 10 years, nobody needs anybody. We're good.
Yep.
Everyone's good here.
Moving plan on. Works.
every plan works. Like, I mean, you could have retired 10 years ago. Like, this thing is immaculate.
Right.
But we know that can't happen because we're printing $1 trillion every 100 days to prop up whatever market this is. If that rug comes out from underneath us, I don't know what happens next.
Yeah.
But that's why controlling risk is the name of the game.
Yep.
Not, we need to be involved because the market has a history of going up. It's lumpy, but determining your proper risk, your proper risk is so important.
Yep, absolutely.
So. All right. Well, that kind of wraps up, don't be a bonehead. But you know what? But again, it's at the end of the day, it's your money, it's your decisions. And all I can do is show you the water. I can't make you drink it.
There you go.
So, good luck investing out there.
Absolutely.
Be careful, but stay involved. And, we'll hit you back on the next Financial Planning Corner. If you have any suggestions for Financial Planning Corner, give us a shout out at info@swpconnect.com, and we can tie that into a show. So thanks, and we'll see you for the next podcast.
The opinions expressed in the podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any investment, legal, financial, or tax strategy. It is only intended to provide education about the financial industry. Please consult a qualified professional about your individual needs.